There you go, Sunday morning weekly market recap. So first of all, I'm going to try to make this quick. A few corrections and clarifications compared to last week video because I just realized, well, actually, it was pointed out to me that while talking about the four major indices for US markets, there was a macro error in the way my charts were displayed. And this is it. Basically, since I'm using this layout both for the four indices and the four, three FX currency crosses I'm looking at. Now, as you well know, if you follow this kind of a recap from the start, I tend to keep the dollar yen inverted so that you kind of have those moving in the same direction, right? Now, the problem with that is that basically the same thing happened with these. So I got the Russell 2000 inverted, and it was looking like all the other indices were going up, and the Russell was actually going down, which is not the case at this point. I mean, they should be just like these, right? So it's going up with the rest of them. So, of course, wrong data, wrong type of concept expressed. Although, should I say, I'm not denying the macro error here, right? Absolutely not. I'm just saying fundamentally, I still think overall, if you want to bet on to the upside, I would still pick the mega caps and big caps for the usual fundamental reasons I've always talked about. Now, of course, I talked about the three or maybe four reasons in the specifics in a video I recorded. I guess it was, I don't remember if it was at the beginning of September or maybe August, but just briefly, mega caps are more liquid, so it's easier to get in and out of them. Therefore, if you need to park money somewhere, they should attract more flows. Plus, mega caps are much more facilitated in actually getting access to funding, so they have much better access to credit, which is, it's not something you should underestimate, of course. And, they are basically better at growing revenues over time compared to small caps. So on a macro perspective, I should prefer to park my money in big caps compared to small caps. And, even if you look at it from a long-term perspective, you should still see that, the S&P, the Nasdaq, they basically had a very huge run, while, the small caps, they didn't even make new highs compared to the 2021, 2022 correction. So, although in the short term you might get these type of rotation trades and whatnot, if you look at it from a long-term perspective, I would still prefer mega caps, big caps, and whatnot, right? So aside of that, with that out of the way, another little thing, if you remember, for those which were particularly patient and stayed in the last week video till almost the end of it, there was that kind of a psychological game I played. So the results are in line with expectations. You put on a bearish title, a bearish thumbnail, and your views are just skyrocketing, relatively to the rest of the other videos. So that video right there, although eventually being bullish oriented, but I guess for the title and the thumbnail alone, it got like 40-50% more views compared to the others. So, all right. That being said, let's start out as usual with the economic calendar. There wasn't a lot coming off of the US this week. So we got CPI from the UK, for instance, and it was below expectations and below the previous print. So again, we are looking at still disinflation in the UK. Also got CPI coming out of Canada, which printed a negative. Wow. Wow. Well, I mean, even the last month was negative. So disinflation in Canada as well. Although, if you look at the year-over-year values, They are still hovering if you consider the median, the well, trimmed, common, don't know how many measures they have, but still on average hovering around 2 point something percent. Still, I'd say disinflationary overall. Um, then you got, of course, the ECB cutting rates once again, just a minor cut, of course. It wasn't a 50 basis point cut, but still a cut, which, if you remember, I don't know if you follow the ECB a lot. I don't know if people living in the US are really paying attention to Europe, but the president of our central bank was particularly clear that up until like 10 days ago or something like it, she didn't see any reason to keep on cutting. And she said in a press conference they were aiming at December for further cuts. Again, doesn't look like that was the case. They actually cut. So, who knows why, right? Might be because they see something they don't like, might be because they see the economy slowing down too quickly compared to their wishes. Who knows? I mean, you know the answer, right? But anyway, now what do we got in the USD? I guess for the week, the most important data was retail sales. Retail sales actually constitute a good chunk of the PCE data, right? And PCE itself is a good chunk of GDP. So for this transitionality property of the data and the way they are all connected and interconnected and linked, this was a data that the market was paying particular attention to. So came in at 0.4, point 0.4, higher than expected and higher than previous, of course, but it was highly anticipated, right? Now, this time around for September, there was a lot of adjustment when it comes down to the seasonality factors of it. So again, basically everyone was expecting a higher than the forecast type of a result. But still, I say the same last month. If you look at the result year over year, right, you see it came in at 1.7%, but for the same period, for the same time span, CPI was calculated at 2.4. So, retail sales, they are not adjusted for inflation. You just get the nominal value of the data. So if you do some quick mental math and you adjust for inflation, at the end of it, comes out that real retail sales adjusted for inflation, if you do 2.4 minus 1.7, what was that? Negative 0.7. So again, to me, it just shows you that people paid more to get less, right? So I know the market just cares about the headline, and the market will trade based on the headline, but over a long enough period of time, I don't think this is a good type of data to look at. All in all, right? It might kick in. If you think about the negative effects, right? They might kick in 6 months down the road. We don't know. As we always say, just because you see something right here, right now, it doesn't mean that everything will crash and fall apart the very next day. When you look at macro data, there is always a lag component into it. The market needs to digest them. And overall, as the thumbnail of this video is probably gonna say, no matter how much data you're looking at, the simple reality of it is that you know nothing. And it was something really cool because I just took it out from a very famous TV show, right? Now, other than that, just for the sake of it, let's have a look at the yield curve, which is still hovering around. It's still uninverted. It's not really going. It pulled back a little bit, and now it's slowly grinding a little bit higher. It looks like, yeah, it looks like, right? So nothing really changed dramatically in here, right? So let's have a look at markets. I want to start out with gold. You remember last week we got this pullback and then basically the market stopped at these levels right here. I was talking about this weekly close on a Friday, which was particularly good in my view, and I was expecting, or at least looking forward to see if the market was able to break the most recent highs at and around 2,700. Looks like we got it. And again, another strong close on a Friday evening. But what really all the week was very bullish. Now, again, when you got these type of prints, these type of price behaviors, it's kind of like in here, right? And like in here, yeah, the market goes up, but I mean, it gets really extended. So just be on the high watch for a little bit of a pullback potentially. If you got access to the commitment of traders chart or data, just check them out. Sometimes it could reveal a little bit of a over or extreme positioning on one side of the market. So just check it out. I don't have it right here right now to show, but just they are updated like if you use the free version, they are updated like every 2 weeks or 14 days, I guess. But still, overall, on a macro scale, they can give clues, I guess. All right. Now, let's take a look at oil. Do you remember oil? We were talking about this kind of a trapped fractal in between these bearish fractal right here on the spike and these bullish fractal right here. So again, oil just came back down. It broke down below this kind of a support, short-term support, and we are just hovering around the lower type of a support. Now again, I was particularly neutral on oil last week, getting into the next 5 days of trading because there were many things going around, especially from a geopolitical standpoint, right? But I guess, after we got that uh, news piece. I don't remember what was that. If it was the Wall Street Journal or another one, basically the title was U.S. officials say Israel will not target nuclear and oil facilities in Iran when it comes down to the retaliation, which is highly anticipated, of course, right? So again, the geopolitical premium that the market is attributing to oil right here, right now, it's kind of low. It's like the market is not expecting at this point Israel to target oil facilities. Probably the retaliation, the attack, the counterstrike will be directed against military facilities, right? So all that geopolitical premium was quickly faded and it quickly evaporated, right? Now again, long term, mid to long term oil, I retain my bias, right? It's kind of like the same as I explained last week with inflation, right? Since I'm expecting lower inflation, it goes hand in hand with lower oil prices, right? That that's basically it. If you would like to sum it up in just one sentence, that would be it. Okay. Now, I think I'm no geopolitical expert, right? To start out, but I think there was a little bit of a discussion in the media about the possibility of the escalation in the Middle East and potentially Iran closing down and the pronunciation of that might kill me. I'm gonna butcher it for sure. But basically, the Strait of Hormuz, if I said that correctly, which, if Google Maps helps me out, should be this one right here, this tiny little part of sea. Now, if you look at the countries which are actually um, connected to this piece of sea right here, as you can see, you got Saudi Arabia, Bahrain, Qatar, Kuwait, uh, the Emirates, right? So big oil producers, right? Should I say? And allegedly they use this trade to send out the oil tank, the ships, and whatnot, which then again will travel to well basically the rest of the world, right? It's very easy from here to get to India, to get to China and whatnot. So there was this tiny little risk, I guess. I think, and again, not geopolitical expert, but I think the Iranians tried out something similar back in what was that? I don't know if it was the the 80s or at the end of the 80s, right? Some sort of a naval blockade of these tiny piece of sea, and they were quickly wiped out by the U.S. Military forces, especially the airborne, right? So I guess it was called Operation Praying Mantis. So again, I don't think the Iran will try out something similar once again. They don't. Probably they don't have the means to enforce a blockage of it. Now, could they use, as they did recently, the Houthis to cause disruptions in the Red Sea once again? Yeah, maybe. I mean, I guess it's all kind of cool up until the point it's not a real government or state government which is actually enforcing these actions of disturbance. It's just a faction, just a proxy at the end of it. As long as the political responsibility doesn't fall upon your head, it's all good, I guess. Imagine if they would actually cause an oil spike by doing something very reckless. I mean, at that point, they again, my view alone. But I guess at that point, they shouldn't just be worried about Israel. If you cut oil supply to the rest of the world, you would basically drag towards you the not so desired interest, a negative interest of pretty much all the world. So US, China, all the people and their militaries will be, you know what, you went a little bit too far, just step back, or you're not you're not supposed to be worried about Israel alone, right? Something along those lines. If you want to throw in a little bit of a geopolitical debate in Iran, and again, I just quickly read something here and there. I'm no geopolitical expert. I mean, fuck, I'm barely a market expert, so you know. But let's look at the 10 years, the usual break evens, 10 and 5 years break even. So yeah, they came back up. They rejected a little bit, but then they closed the week up a little bit. So don't know. Can Is it possible that the market is kind of starting to price in higher inflation expectations for the future? It still goes against my long-term thesis, right? But at the same time, you can't just deny it, right? It is something that you need to pay attention to at the very least, because I mean, it would be disingenuous. It would be silly to just take the data and you know I'm being happy of seeing these data and these prints when they are actually confirming your thesis, but then just discard them when they're not, or when they are not agreeing with your thesis. That's just bullshit, that stupid bias seeking and confirmation bias, right? So again, I'm looking at it. At the same time, price of oil came down a little bit. So, for now, I'm still, again, slightly bearish and slash neutral over the very short term. But medium to long term, I still think, as for inflation, that we should expect lower oil prices, right? So that would be it for me. If you look at the curves from the futures, you see that the wow, the low was, wow, 68. Wow. But down the curve, if you look at December, it's lower. No, it's actually a bit. Yeah, it's lower. And then January, it's lower again. So still, even the futures market is pricing in lower oil prices into the future for the next quarter at the very least. All right. Now, let's have a look at Bitcoin, and I guess many people out there are having erections all right, left, and center at this point, right? Again, Bitcoin, I said, it's very hard for me to be bearish Bitcoin when I'm looking at the rest of the risk on assets out there and they're all bullish in my view. So, although again, Bitcoin was kind of trapped in these fractals right here, right? Kind of like on oil, right? The bullish fractal and the bearish fractal, we ping ponged in between the two of them for what? Um, 2 weeks, kind of, and we finally broke to the upside. It's kind of cool how we traded into this gap. At first the gap was kind of tapped in and rejected strongly, and then it was completely, flipped with a very sharp and impulsive movements, a little bit of a drawback into it just to flip it, and then it goes up. Attack these expected resistance, a little bit of a starter step, as you can see in here, like 2 days, but grinding into it and then finally breaking above it, and currently is holding above it. So again, you shouldn't discard a little bit of a, let's say, it depends on how next week will open up, but I'm not saying you should discard a potential or little bit of a ziggy-zaggy type of price action in here before going high, right? Uh, could happen, right? Uh, but overall, regardless if it does it like these or it goes directly from it for it, I think next target should be these last or previous resistance, and then eventually this one right here. Okay, I mean it is going up, right? So don't fight the tape. Right? If it's going up, just align with the current order flow of the market. Now again, be aware it's in the nature of the asset being a little bit on the volatile side of things. So just don't discard any potential sharp drop, which is quickly recovered then. But overall, the bias should be to the upside. All right. Then as for yields, we've seen yields kind of flip-flopping around. They came into this apex. They had the initial response that you might expect, and they closed the week on a little bit of a bounce, but still, up until the point they're not really able to reclaim this level right here for the long end, and this level right here for the short end, so the medium end. And up until the point you don't see a little bit of what? Would you expect to see some sort of a head and shoulder reversal pattern forming in here? Yeah, I guess if you're bullish yields, bearish bonds, that's what you might like to see. Would be also nice to see something similar to it being depicted, and then at the very last moment being quickly faded, and you got a little bit of a pattern failure, and yields just collapse down. Who knows? I talked a lot about my views on future inflations and growth expectations, so I'm not going to repeat that right here, right now. If you want a little bit of that, just go to last week's videos. It was all in there. So conversely, bonds, they had that little bit of a bounce. We were talking about these standard deviation type of move. Sorry, that really came out badly. We were talking about this move, a very extended move, which reached into it. That's way better. Uh, 1, 2, 3 standard deviations compared to long-term averages. It was the same. It previously was to the upside, and now it was to the downside. So we were specifically looking at the 10 years for that. So, a little bit of a bounce was due. We got the bounce. The bounce, it looks like it was faded a little bit, but we are still hovering above previous support. So, wouldn't call it defeated yet, right? And again, despite the short-term ebbs and flows, it would be kind of silly on my end to completely throw into the trash bin my long-term thesis just because we had a little bit of a volatile week, right? So again, still looking for an extended bounce right in here up until the point we can sustain these levels, let's say for the TLT, right? Wouldn't like to see it trading back below the 92, 91 levels. This one might have a little bit of a room still to retrace a bit deeper into this pocket right here. Wouldn't be unusual, right? But at the end of it, again, as the current moment in time, I'm still retaining my view overall, right? Let's look at currencies. I actually moved the currency. The currency tab, it was usually at the beginning, but yeah, just to prove a point. Now, You're seeing the DXY having this little bit of a pump right in here, and conversely, all the other currencies like the euro against it, the pound against it, and the yen against it, they had this little bit of a sharp pullback. Now, I think it's interesting when you look at something else like the volumes which are actually coming in into risk on assets in the US. I got two charts for it right here, right now. Maybe it's just one, but just to prove the point that um, usually people tend to see the DXY with an inverse relationship compared to, let's say, I don't know, the S&P, right? Because you see that when you got risk off, everyone is piling into the dollar because the dollar is this kind of a safe haven. So if the dollar goes up, even if it's, again, it is the DXY, right? It is just an index. Surely it doesn't reflect the situation of the dollar against any possible fiat in the world, right? It's just an index, so it's just against a basket of currencies, mainly the yen and the euro, right? But anyway, if you see, as a general rule of thumb, let's put it like that, if you see the dollar as measured by the DXY spiking up, that's usually risk off, so that, therefore you should see risk on assets like the S&P going down. But, that's not happening, right? Actually, you see the dollar coming up, and, well, when you look at the S&P over the last 2 weeks, I don't see any particular sign of weakness. Same for the Nasdaq right here, right? So why might be? Well, it is again because when you think about risk on, risk off, and how people are moving capital around, so how the capital flows are structured at the current moment in time, let's think it this way. If you want to buy risk on assets, mainly US equities, right? Mm, what do you need, first and foremost, in order to be able to acquire them? Well, they are priced in dollars, right? So you need dollars. So a strong dollar, right, actually attracts more capital flows from the outside of the US into the US. Then when you got those dollars, you need to put them to work somewhere, right? It could be equities, could be Bitcoin, right? Could also be gold if you still consider gold is, for the majority, it's still priced in dollars, right? So again, to me, it's not a surprise to see overall, even on a macro scale, right, the dollar being basically for the last 3 years, right, being overall strong against the fiat currencies. And at the same time, you see that US markets are performing really, really better compared to all the rest. Even discounting these recent erections we've seen in China because of the Chinese stimulus and whatnot, we are gonna see if that's up to to last or to be faded. Uh, but uh, if you look at long-term returns, um, there is usually um, a lot of reasons to be in US markets compared to the rest of the world. They really tend to outperform, right? So again, not surprising to see a little bit of a dollar strength. Also, again, I know it sounds like a broken record, but if you look at these long-term range, once again, we've never been able to break out of it. We had deviations to the downside and the upside, but overall, look at that. We gravitated once again toward the equilibrium point of it. And by doing so, we actually filled in a few pockets of inefficiency, like right in here, and most recently, could say right in here. Although the upper one was already partially filled on this rejection, right? But now we completely filled in. So again, it's the dollar, it's not really going anywhere, right? If you look at these price levels, those are the same of war. February 2023, December 2022. And I mean, look, at the end of it, that's good. When you want stable markets and therefore markets which are slowly but surely grinding and moving to the upside, you would like to have the dollar relatively stable, right? So, I mean, there is nothing unusual to be read in these charts, the way I see it, right? If not, an overall and macro dollar strength against the other fiat. No matter all the topics and the talks about de-dollarization, the debt issue in the US, everyone will reject US bonds and the dollar will collapse and the BRICS and whatnot. I mean, it is a good narrative, just in my view, personally, just forget it. All right. So that would be it for me. So conversely, you've seen recent days, Nasdaq futures, they had that little bit of a drop on Tuesday, but overall they kept on trading to the upside after that. We've seen the S&P kind of doing the same, but I mean it's not unusual. Like you break to new highs, you got like 5 days up. Is it that bad having just one day drawing back and then keep on going higher? I say it's not. It's actually particularly healthy if you consider of if you think of an efficient movement to the upside. It's even better if you got that, so you don't have gap risk to the downside going ahead into the future, right? So again, to me, everything is kind of cool for now. If you look at this chart, this layout that I use for just the two main ETFs, the spiders and the triple Qs, is everything cool? Like the market is moving up. It's about even fast moving averages. The orange is the 20-day moving average, right? Yeah, okay. The Nasdaq it's lagging a little bit behind, but at the same time you have a much better market breadth, right? So it's not just one of the main criticisms toward the stock market was, yeah, but it's just the Magnificent Seven, right? It's the Mark 7 which is dragging the indices all up, but the rest of it, it's just, doing nothing. And look, there is a fundamental truth into it. Like if you look at how the companies represented by the S&P are actually able to grow earnings, a lot of them, the majority of them, are seeing an earnings growth which is kind of flat. All right. So from that point of view, it is still true that just these big tech caps, mega caps, and whatnot are still able to generate and grow earnings, while the other are really struggling. But at the same time, if you just look at the price action, you say that, well, at the end of it, if everything is going up and it's not it's not like it was before where it was just these seven stocks going up, but we got a little bit of a much more organic type of price appreciation across the board, right? Wouldn't it be even better? Wouldn't it be even healthier for the overall market, right? And the reality is, yeah, that should be, right? Now, look at these for instance. So the why did I say in the beginning, at the end of it, no matter all the market data we can look at, we do know nothing, right? Well, it is because you can look at all the things you want, but ultimately, what drives markets, in my view, which I guess it's would be, agreed upon by many different other people, right? I still think that liquidity drives everything, right? Liquidity drives it all. So if you look at these, for instance, these are basically the exposure of, you know, uh, inverse funds and levered funds, and you can see that it's massive. Everyone is pouring money into these risk on assets, right? Now, why should it be, right? Well, you know, it's like everything in life. Up until the point it's going up, people actually feel particularly comfortable keep on buying it. Um, Not only that, but we were talking about last week about the earning season, and then when you come off earning season, you're going to have an additional buying market with the buybacks, right? Stepping in once again, and even the retail the retail investors are dragged in. Now, think about the dynamic of passive investments, right? So when you think about the ETFs you can find around there, right? Um, when you buy an ETF, it is normally weighted, right? There are gonna be some components which are weighted more, some others which are weighted less. But the point is that if those are weighted by market capitalization, every time you buy an ETF, the majority of it is going to go not only in the S&P but among the S&P components in the stocks or equities with the higher market capitalization. And again, this is another reason why I say just, just bet on big caps and mega caps overall over the long term, right? Um, so, despite the composition of it, you can see how liquidity is being dragged in, and that basically sustained markets so far. Now, this one is another interesting one. This is just an indicator, and it shows you the overall tightness or maybe looseness of financial conditions in the global financial markets. So essentially, it looks like we are or at least we are beginning, maybe in the middle of an easing cycle, right? So if you got easing policies, of course, then liquidity conditions should kind of improve. Therefore, more liquidity available for markets, right? And so if you pair these up with all those moments where financial conditions were actually tight, which should be represented by the negative levels on this chart right here, then of course you would notice that guess what? Tightness in financial conditions actually correspond with massive drops, not only in the ISM. In this case, they're using the ISM, but if you pair it up with a chart of the S&P, it should depict the same type of a behavior, right? So market drops. So again, it's hard for now, at least again for now, to fight the tape. Up until the point something changes in global liquidity, there is this liquidity cycle, right? Up until the point something changes there is no reason to keep on betting against risk on assets, equities and whatnot. So just again, just stop fighting the tape. Um, should I say though, there is something which is, I mean, it is of particular interest, I guess. So this is it. If I can find it back now, yeah, where was it? Don't have it anymore, right in the chart. See if I can find it back. It was here. This one. Let me load it up. So these are basically credit spreads, right? Now, why are credit spreads important? So basically what they measure is the delta in between the yield that you could have on, let's say, US Treasuries, so the risk-free type of benchmark, right? Against the so-called junk bonds, so riskier type of bonds. Now, of course, by the simple logic of it, credit spreads are usually very tight, of course, when there is not a lot perceived risk in the economy and financial markets, while they tend to get wider when the perceived risk is higher, right? And why is that? If you think about it, right, it would be simply put, it is like this. Let's say the holding a 10-year treasury, it's yielding you maybe 3-4%, right? Just random numbers, right? At the same time, when you see that holding, let's say, corporate debt, right, it's yielding kind of the same. It is like, I mean, the amount of risk is not the same because I do know that the US government, allegedly, it can't go bust, right? But a corporation could. So why should I be paid the same to hold two different type of debts, which inherently have a different risk when it comes down to being able to see the return on my capital, the return of investment, right? So again, if these spreads are actually compressed, that tells you that the risk perceived is very low, because when risk is a bit higher, you should see a much higher premium on junk bonds or corporate bonds compared to the risk-free rate. Because naturally, you might say as an investor or a buyer of that debt, yeah, you know what, don't like what's going on. I could get like 3-4% on a US Treasury right now. So I mean, they can't go bust. So dear corporation XYZ, if you want me to buy your debt, I need a much higher premium. So I'm not going to buy it unless you offer me like 7-8% maybe, right? Because I deem you as a much more risky investment compared to simply put my money into treasuries, right? And you see the spread actually going wider, right? So investors usually say that this is a measurement of overall risk and liquidity conditions into markets. So if you see them blowing up, that's where you know something is going really oddly and really strange and probably bad in the underlying of financial markets and therefore liquidity and credit conditions, right? So just could be one metric to pay attention to. There is, in my view, a huge controversy, especially right here, right now. I'm not gonna go into it right now because it would require like, let's just say 20 minutes of talking. But I invite you to just look at what happened in Japan recently, past few months, with Norinchukin Bank and what they did to offset the negative carry they had, and therefore they went, down the risk curve and they started to buy US CLOs because they are yielding more, of course, but they are also riskier, right? They're yielding them more, so they help them kind of filling the gap and get rid of these negative carry that they're seeing and which is impacting their balance sheets. All in all, what I'm trying to say here, to be short, is that this type of signal could be a little bit, I don't want to be flawed, but it could be a little bit subdued by the current dynamic we are seeing in global financial markets. Now, the Japanese banks one, it's just one example. But what happens is that if these entities are going down the risk curve and they keep on buying these risky assets, naturally, these spreads are not going to blow out because there is still demand for those risky loans, CLOs. But if there is demand for that, they're going to be a bit higher and still they're bonds. So there is an inverse relationship in the price of the underlying loan or the bond in this case and the relative yield. So if price of the CLOs, let's say, go up, the yield goes down. It's like with treasuries. If the price of the 10-year treasuries goes up, the 10-year yield goes down, right? So just one thing, if you just want to look into it and make a little bit about your own research, could be interesting. Sure, again, as any other thing, it's probably not gonna give you the exact depiction, but still, I think it's something to consider, right? Now, let's finish off with this because I've seen people talking about it. So basically, this is the S&P, right? Well, ES futures, and below it you see the VIX, right? And there are two levels I highlighted, like the 20 and the 30. Now, why is that? Because a lot of people are saying, well, you see, yeah, it's true, the S&P is going up, but at the same time, the VIX is going up as well. So should we be kind of worried? Worried about it? Should we be concerned about it? Like, because the VIX it is usually uh, you know the volatility index, of course, but it's also called the fear index. So I'd say, I digged a little bit into it. And, first of all, what's the VIX or how it is calculated and what does it represent? Well, in a nutshell, I'm using my own words, so give me a little bit of a leeway here. But the VIX just uses the price of a lot of 1 month calls and put options onto the S&P, right? And it it weights them based on the time to expiration and the differences between the strike price of these options and the current price of the S&P, right? Now, based on this price, the variance, let's say for the S&P, is kind of estimated, right? Now, there is of course some type of a complicated math in between, which I'm not capable of actually unfolding, of course. But the bottom line is that at the end of it, the value of the VIX is it just express the annualized percentage, right? It is expressed in an annualized percentage, and what the VIX represent is basically the possibility of a one standard deviation change. So let's put it this way. If you got a VIX of 15%, right? It basically it's telling you that the option market it is expecting a 68%, yeah, right? Yeah, one standard deviation, so 68, yeah, 68% certainty of the S&P to trade in between a 15% range from the current price levels for the next year. Now, I know said like that it might be a little bit difficult to grasp, right? But let's just take a look at a chart for just to get an example, right? So in here you see the S&P, of course. In here you see three different values for the VIX. I guess that's where it was maybe 2 weeks ago. That's the high, I guess, for the current year. No, yeah, that's the high, 38, 37. Right? Okay. So basically, as I said, maybe it's even better if you see a visual depiction of it. But basically, a VIX of 12, it says that from current prices, the option market is pricing in a 12% range, to the downside and the upside from current price. There you go. Now, if you look at the blue line right here, a VIX of 22, it implies a 22% type of a range above and below current price. And there you go. That's the potential variance the VIX is attributing to the market right now. And, same goes for the 37%. Now, look, does it tell you anything about direction? No, fuck no. It doesn't. It just tells you the amount of implied volatility the market is pricing in right here, right now for the underlying asset, which again, implied volatility is different from realized volatility. So bear it in mind, right? Now, another one you could look at, if the VIX is not enough for you, but another metric could be the put to call ratio. Now, the put to call ratio, it's, I guess, one of the simplest. It is just you take the volume of puts and you divide it for the volume of calls in the market right now. Okay, so it just measures in a way the type of a risk perception investors and market participants are kind of attributing to the market right now, because the if the value it's lower, right? Let's say the value that you get it's below 1, right? That means that there are a lot of people which are buying calls compared to puts, right? If I said that right. let me think a little bit. Yeah, if the ratio is below 1, that would be suggesting a bullish sentiment. Yeah, a bullish sentiment, I guess, because there are more call options which are purchased compared to put options. Yeah, and the opposite should be true, right? A ratio above 1 should say that there is a bearish sentiment because there are more puts which are bought instead of calls. So what happens? If you're buying more put, you're edging yourself to downside risk, right? So the market is pricing in a little bit of a possibility of, you know, a pullback, a downturn, what have you. While if you're just buying calls, or the majority of market participants are buying call, they are pricing in upside into the market, because when you buy a call, you're basically paying a premium and you got infinite gains possibility if the market goes up, and just a limited type of a loss if the market goes down and your option expires worthless, right? So this is just another one, and currently is, as you can see, is very low. So again, it's not it's not really saying that the market is expecting some sort of a downturn. Actually, if it is below 0.50, that should be that the amount of call should be double the amount of puts, right? Yeah, I guess so. Again, I'm not that good at math, but I'm just interested in the logics of it, right? Now, then you got another one, which is the CBOE skew. Now, CBOE skew, it works kind of like the VIX, right? Just this time around, instead of looking at, well, first of all, it's not looking at first standard deviation type of moves. So it's looking at tail, how do they call them? Uh, tail events, right? So moves and changes and variations beyond the first standard deviation. So we're talking about 2, 3 standard deviations type of movements, right? Um, of course, it moves in the same direction as the VIX more often than not, but it's just measuring tail risk. So at the very extremes of the spectrum, right? Now, the skew actually uses out of the money options onto the S&P, right? And the value of it typically ranges in between 100 and 150, right? So again, when it stays in the middle of that range, let's say 120, those are usually stable environments, right? And if it starts to rising above 120 and it goes toward 150, that where usually investors and market participants are starting to edge their risk, right? So again, you see how again this type of indicator right here, or metric, could give you a little bit of a clue of what might come. And again, the problem with volatility is that it can cut both ways, right? So you never know if it's going to go up or down, but at least you kind of grasp the potential roller coaster coming into markets. So it's just telling you, yeah, dude, we think over the coming months or year, the market might be a little bit volatile. So pick your poison. Do you want to ride it and just being steady, having time on hands, or do you just want to start to hedge yourself? Yeah, just in case something goes wrong or something goes against you, right? So, that's what I would have to say when you talk about these. It's not something you should be majorly worried about at the current moment in time, but it is just showing you and giving you these type of signals. But again, it doesn't really tell you anything about direction. Like if you look at these value of skews, right? Oh, this is just a chart, right? It tells you that when the skew value is around 100, the market is pricing in a 2.30% probabilities of a move or a change in the price, which correspond to a second standard deviation move, and a 0.15% third standard deviation move, and so on and so forth, right? The higher the value, the higher the probability of a second or third standard deviation move. Still, you might say, well, why the percentages are so low? Because we are still talking about 3 standard deviations move, right? So, again, tail risk at the very extremes, right? So if you are concerned about these, just take a look at these just to give it a little bit of a context. Now, there were, and this is why I got 20 highlighted on my chart, right? There were many periods in the past where the VIX was above 20 or spiked temporarily above 20 and towards 30. even throughout the dot-com bust. It started in 1997. Imagine if you just sold everything just because the VIX was spiking. The market kept on going higher and higher for another 2+ years. All right. Eventually, you had the bust, right? But does it, again, does it tell you a lot of stuff about overall direction and timing? No, in my view, not really. Okay. And look at the 2020, or at least after the 2020, right? The market is going up, but the VIX is still higher, right? But look how much the market goes up before actually having this little bit decent pullback. It took it 2 years, right? So again, it's just another one of those things where it is sensational, right? But at the end of it, when you put it into context, you do realize that overall, uh, it's just another data point. So again, I would say just follow the price, right? Which is why, again, I'm gonna finish up with that. We keep on looking at a lot of different stuff, a lot of different data. We try to grasp what will come into the future, day after day, week after week, and no matter what, we got still much more odds to be wrong than to be right, right? When we, at least when we try to forecast, you know, price movements so far ahead into the future. Now, of course, if you tell me, oh, but you keep on talking about next week, so how can you do that? Well, look, the more you go ahead into the future, the bigger the possibility of making mistakes is, because there are much more variables coming in if you extend the time span of your forecast, right? And a lot of stuff could actually change in the meantime, right? While instead, if you try to forecast something for tomorrow, next 2, 3, 4 days, next week, maybe even next 2 weeks, maybe even a month, right? There will be a lot less variance and a lot less possibility that something will happen, from a fundamental standpoint, from a geopolitical standpoint, and whatnot. It is as simple as that. Which is why I keep on saying, you know what? At the end of it, maybe, yeah, should we look at all these macro indicators, macro data, reports, data points, and whatnot, or should we just stick to price and be guided by price movements, market structure, price action alone? Yeah, I'd say at the end of it, price is the ultimate arbinger, right? So just follow it if you want to have a much simpler life, right? Although, I keep on tracking this macro data, mainly because I like it, right? And I like all the discussion around them, mainly because they are interesting. And although, they will probably take a lot to unfold themselves, but eventually they will. So it's like, it's not a matter of if, it's a matter of when. The problem in market is like just, timing it tends to be a very important component, right? Because, being early, being late, it's the same as being wrong, right? So I keep on following them anyway, but still, I know, I mean, I'm aware that overall they could mean a lot of stuff, they could mean nothing. It all comes down to your timing and to how you can actually react to the market moving around and how you can adjust your sizes. Look, um, the worst thing that could happen to you, and that goes for, I guess, long term and even intraday type of trades, the worst thing would be being right on a trade. I mean, this is just one of the bad things which could happen to you in this environment. But being right on the overall direction of the market, and so being right of the trading idea, you might be right on it, but then you put on such a high levered position that you need to get out, otherwise you're going to be wiped out. And at the end of it, the market will just squeeze you out and then go in that direction. So I guess, position size is kind of a huge topic you should pay attention to. both on the macro side of things and on the intraday side of the spectrum. All right. So with that, I guess there's nothing else I want to talk about. I guess the message is particularly clear. Be kind of like Socrates, right? True wisdom is knowing that you know nothing. And you're gonna do fantastically, right? It's kind of like, oh, well, you know what? Expect the unexpected and you're gonna be fine. Now, with a little bit of a practical joke, I wish you a good rest of your Sunday. And as usual, be nice, be cool. Niels out.